For your real life and real future, Tom and Don are talking real money.
Ladies and gentlemen, boys and girls, welcome once again to another exciting edition of the Talking Real Money podcast. And, yeah, you get to see us, videocast. Hi, all. I am Don McDonald in the Florida studio of Talking Real Money. And there in the Woodinville / Maltby up on the hill in the snow. Oh, no, it's not. The snow's gone. Is Mr. Thomas C. Cock. And he's there for your enlightenment, edification, and entertainment. Prod him, poke him, do whatever you want to him.
And the studio audience, still the chair. If those of you,
oh my gosh, the chair is back.
The chair is back. It's empty though. Still,
chair is there.
That chair is worth more than my car. So we
haven't
keep it
talked
here
about the chair.
Office.
I can't. Yeah. Good luck trying to resell it.
Well, I'm gonna die hugging it.
Do you know that you people don't want any of our crap anymore?
No,
it's so funny.
I know.
My kids don't want our, because I'm married to a very traditional woman who
that's what we're gonna call her.
We have the china and the silver and all that stuff, and in my head, I'm way too young for all that crap.
Stuff. It's stuff if it's yours. It's crap if it's somebody else's.
Got it. Well,
that's
crap.
what Carlin says.
But nobody wants it. Nobody. You can't sell it to anybody. My wife said, "Go look online. Go to this website and look up this china." And I looked it up. It was like $7 a plate. And she went, "Oh, is that all?"
My mom. I just found bicentennial plates my mom bought that I think she thought would be worth millions by now.
The Franklin Mint garbage?
Whatever. They're all worth $1.49. I'm like, I love you, Mom, but
was it the Franklin Mint stuff?
Somebody else. It was a step above the Franklin Mint. So
yeah, my ex-wife used to buy that when we were young. It's good. Oh, because her parents told her this stuff is going to go up. Yeah, I said in the divorce, I said you can have those plates.
Things that are
you can have all
up.
the plates. I don't want any other plates.
Keep the one in my head, but the rest are yours. So yeah, got it.
And speaking of plates, what rhymes with plates? Target dates.
Oh, look at you. You are really on today, man.
I'm not. That's why the pun was so bad. The joke, the whatever it was called.
Because after you listen to it, it really grates. Sorry, too easy. Just set me up. I'll keep them coming.
And you see, I thought I had an excuse. I'm just like out of it, but that's okay. You apparently are too.
From me, it just emanates, as you may know. So.
Oh, man, there it goes. I'm palpitating.
Okay, you're not looking
I'm going to palpitate.
Good. Your face is kind of red. I see some. Okay, all right, we better get to it.
No. That's my fate.
Oh.
All right, it's not too late. We'll go ahead and get to the target date.
Inflate? Yeah, okay.
All right, here we go.
I'm sorry.
Ladies and gentlemen, welcome to the dumbest edition of Talking Real Money ever. And we've had some pretty dumb ones, but this one I think takes the cake.
It's silly.
Which
I prefer
sort of
silly
All
over dumb.
Right.
Okay. Yeah.
Oh my gosh, you are Mr. Language Guy today.
I don't know where that's coming from.
Please use the proper language.
And now I'm going to get in big trouble when I mess up.
You're sounding like some old guy.
We don't use that language around here, Sonny. We just
I'll break into Latin soon, so be careful. Caveat emptor.
What were we going to talk about?
Carpe diem?
Target dates.
Ah, that's right.
Target date funds. Now, we often on Talking Real Money suggest that you use target date funds, but it's not because a target date is great. It's just because
you're running late.
No, it's because they're adequate.
Are we really actually going to broadcast that anyway? Okay,
it's YouTube. We only have like 750.
That's true.
Subscribers, so it doesn't really matter that much. When we get into the thousands, this would be embarrassing. But right now, it's a few people.
So 2 people at least will write me about this and say, "What were you doing?" Anyway.
No, but they're merely adequate. We suggest them because they're better than nothing, and it's really hard for most of us to set up a well-diversified portfolio that is semi-appropriate for our position in life. Is that a good way to
Yeah,
put
I
it?
think that's fair. I mean, the other part is in a 401k plan, generally, they are less expensive than the other options, right? Generally.
Generally.
Yeah. You're right. It's hard to build a really diversified portfolio with the assets, the types of mutual funds they offer you in a 401k plan. And it's not only hard because they don't offer them, but it's hard because it's hard to do.
Mm-hmm.
Most people can't really how much in large, small, et cetera, et cetera. So
However,
they're a fallback. Yeah.
However, they're a fallback. They're merely adequate.
Yeah.
If you want to do it right, they have some giant shortcomings. And the biggest of those, and we have talked about this for a long time, but Jason, it was Jason, right?
No, it was Mark Hulbert.
It was Mark Hulbert. I knew it was one of those guys. Mark Hulbert wrote a piece about it recently,
Yeah.
talking about how they're okay, but they're too average. They don't take into account individual differences between investors. It assumes that everybody who's 70 years old invests the same way. Everybody who's 20 invests the same way.
Yeah, it's fascinating that we assume that as investment managers. That's a problem, I think, bigger than just target date funds. But they were talking about a new study that found that they're very inadequate. I mean, they really can't solve for a lot of the issues people have when it comes to their money. And they point out that no other modeling of equity allocation up until now has taken into account nearly as many variables when they're talking about this new method of AI that they do. Now, I struggle with this a little bit too, Don, because they talk about, well, one part of it should look at your net worth. I think that's probably true because you have $10 million, then it's okay to take more risk, right? Because you don't have to live off the money as much. But then they start getting a little nervous. They talk about, well, then you've got to look at the state of the business cycle.
Mm-hmm.
That sounds like timing to me.
Yeah, now they're getting into the stupid weeds.
Yeah, and then the market valuation.
I'm sorry, the dumb weeds. No, wait, it wasn't the dumb weeds. It was
researchers. They used the market dividends to price ratio. The higher the ratio, the cheaper stocks are. Then you invest more in stock. I mean, you start getting into these. Talk about silly. I mean, I think it's very silly. But here are the reasons that I struggle with target date funds. And we've talked about this on the program before, that sometimes the best option is target date fund plus, and we'll steal this from our friend Paul Merriman, 20% in a small cap value fund if you have that available. But number one, and you mentioned this, Don, most of the time one size does not fit all. It wouldn't fit all for the two of us, right? It doesn't fit all very often because people's situations are enough different that just because you're 60 doesn't mean you should only have 40% of your money in stocks. Number two, when you go out to eat, do you just get the blue plate special every time? Or do you actually order from something?
Wow, you really are old. Is there a single restaurant in America
Joe's Special? How about that
still
instead?
serves a blue plate special? Come
I think so.
on.
You're going to challenge me to find.
Okay,
I'm
looking
how about
that
Joe's Special then? All right. But here's the biggest one.
Only if you go to Joe's.
Because their own chart shows this in the article, which I think is valuable. That most target date funds, by the time you get to retirement, have you half in stocks, half in bonds. Most people are going to need more in stocks because they haven't saved enough, because they need a greater return on their money. They may say they don't want to because they don't want to live with the volatility, but most of the time, the cases that I see, you're going to need more in stocks. So if you're only half in stocks, what is your expected return? Well, it's been pretty good looking back 50 years, but today's with bonds paying less than 2% a year, and actually bonds losing money over the last 3 years, you're not making much on that part of the portfolio. Therefore, you need to have more in stocks, which should be more productive into the future. So I'm going to argue that they're right about the fact that most people need more in stocks, and especially in retirement, because people are living longer. I know there's another well-known financial advisor that I just read his website today, and he says, if you live to 65, the likelihood you're going to live to 110. Well, okay. I thought the life expectancy went down last year in the United States or the year before. But at any rate,
damn lies, statistics and blue plate specials.
The reality, Joe Special. The reality is that you're going to need to have more of those things that are going to go up faster than bonds. Target date funds probably will not give those to you.
And just to let everyone know, Vicks biscuits and burgers
You only found 2? Well, that's kind of disturbing.
Vic's, that's the name of the restaurant, Vic's Biscuit and Burgers.
Is that local? Because I haven't been there.
Beautiful Laurel, Mississippi.
Oh, well, that's a little ways from my house.
Has a blue plate special every Sunday through Friday.
I said blue hair special, not blue plate special.
Blue plate.
Okay, all right.
On Sunday, it's baked chicken with meat or meatloaf.
Okay. I'm going to go with the baked
Monday,
chicken,
it's the fried pork chops or beef stroganoff.
Well, that's a good option.
You can get spaghetti and meat sauce or ribs on Tuesday. How about chicken spaghetti or a hamburger steak on Wednesday? Thursday,
is this the only
beef
location in the United States that offers a blue plate
Still,
special
yes,
anymore?
Laurel, Mississippi, Vic's. So
just wait till the 20th century arrives there. Is that what you're saying?
When you're in Laurel, stop by Vic's and tell them Don and Tom sent you.
And get the blue plate special.
But you got to get the blue plate special.
All right, I'm old. I agree. I admit it. So that's why I threw in Joe's special
that's something that's like you see that in 50s television shows or 1930s or 40s movies.
I'll have the blue plate special, please.
Okay. All right. Taking back the blue plate special part, still important for most people to have more in equities than in bonds for the long haul.
And here's the simplification of this. You don't want any of these market timing indicators or market health indicators because they're wrong as often as they're right. They tell you nothing. What you want to do is make sure it's right for you. That's the trick. And if you can't do that, then you better find a really good 100% fiduciary who can help you figure that out. Because particularly as you get older or as you get closer to retirement, you want to make sure it's right for your needs. You could be 80 and still be 90% in equities. It's okay with me as long as you're okay with it and your situation allows for it.
Yeah, I think that's fair. The portfolio should be designed with your situation in mind, not with the market's situation, because nobody knows the market starting tomorrow, period.
And we're going to be recording podcasts every hour on the hour for the next month to get through all of your questions here that were sent in, mainly that were sent in to Talking Real Money. You guys do love to type.
Can I, before you get it, can I just give you one that just got called into me? Because maybe you can answer this better. He wants to know, great call. Yeah. He wants to know how he gets his 83-year-old mother to separate from Edward Jones.
Oh, good luck.
That's what I said. I said I used to argue with my 83-year-old mother. Never won an argument yet.
No,
so
because here's going to be her argument.
I've been with him for a long time.
Yeah, right.
And he's so nice.
She's
like
worried,
part of the family.
He's worried that she's going to live to 110. So sorry.
Well, maybe the Edward Jones broker will die first.
I hadn't thought of that aspect.
And then it's easy to change because the next guy probably isn't going to be so nice. Maybe just be a money grubber.
All right. So your answer is the same as mine. Give it up. It's over.
Yeah. I mean, would she be better off? Probably. But, oh, well. It's not that dramatic. It's not like she's in an indexed annuity.
We'll hope.
Yeah. All right. So we have a question.
Yes.
I think you're aware of this one because you sent it to me.
Oh.
You did. You sent it to me with a note saying, we will use this. This was such a nice way to put it. Shall we use this on a podcast? No. From Tom, we will use this on a podcast. So let me just get right to the question that we will get to.
Replicate. Yes.
Happy New Year.
Oh, okay.
I contribute to a Roth 401k. I understand there won't be any tax consequences on Roth 401k withdrawals down the lane, but if my 401k is both Roth and traditional, then how would the IRS tax me when I withdraw my money in the future? How will it be clear which portion is traditional and which is Roth? Also, can I roll my Roth into a backdoor Roth at any time? If yes, can it be done when I'm actively employed with my current employer with whom I have my Roth, or can it be done only after I leave my employer job? And then I'll go on.
Okay, well, the first part is the separation between pre-tax and post-tax.
Mm-hmm.
They're keeping
had this
track
one
of
before.
That. Yeah, we've had that recently. They're keeping track of that. I don't know how easy it is to see in your plan because every plan is different. In terms of rolling money out, sort of an in-service distribution, that's a plan-by-plan decision. Most of those do not allow that to happen until age 59 and a half. Most. So I wouldn't count on it any earlier. And then the other part would be kind of why? Why do you need to move it out? unless you're unhappy with the options in your current plan. So, that again, there isn't one right answer to that question because every plan is set up differently. That's the part you need to know.
Well, and he says the reason I would like to roll my Roth into a backdoor Roth, possibly Roth 401k, is that I read, into a Roth IRA, is that he read that Roth 401ks are subject to RMDs, but Roth IRAs are not.
Well, Roth IRA, yes, you still have to take the money out. You're not paying any tax on it.
You have RMDs?
They didn't they change that?
I don't think so.
Now you're gonna make me look that up.
I'm going to make you look that up because I don't think so. Let's look.
Yeah.
I don't.
Roths require no RMDs during your lifetime, but heirs must take them. I had it wrong. Let's see. Traditional. Yes, you're right. There are no RMDs for Roth IRAs during the account owner's lifetime.
But are there Roth 401k? Yes, Roth 401ks have to start taking RMDs. Well, there you go. Now,
okay,
he
has a subsequent.
Yeah, that's a big reason to get it into a Roth IRA.
Yeah, you don't have to take it out of a Roth IRA. You do have to take it out of a Roth 401k. That makes sense.
That is correct. The Roth 401k owner must start taking RMDs in the year they reach 72. Yeah. Okay. So now he also had a subsequent question.
Yes.
Also, what do you think about Frank Vasquez, who does risk parity radio podcasts where he
still
discusses
owes me money from high school, I think. Is it the
You've
same
used
one?
that joke before too.
I only have 10. The year's young. I'm going to keep using them.
But you need to rotate them a little bit better. You need to keep a list. Check it twice. Oh, great. SmartAsset's calling me. You remember SmartAsset, don't you?
Yeah. These guys, we should put them on the air. No, please don't. I'm kidding.
He's calling me because they are bound and determined. A little aside. You
Let's
guys are going to
tell
love
them
this.
here. I mean, this is a great story.
We decided to see if we could get some client leads from SmartAsset, who's ringing right now. Hear that? So we did. We paid for some leads. They're supposed to give you great leads for clients who are, ready to become clients and people you can really help. And we had a terrible, 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 terrible time with all these people because the people we called, they were all people who were watching CNBC and wanted to work with an advisor who could promise them the biggest returns.
Yeah.
Well,
they were shopping returns.
We don't do that. So they went, well, and why should we hire you when all these other guys will promise us big returns? And we went, they're lying, but okay.
We did end up with one client.
Okay, that's better than I thought.
Yeah, it's one, but I think it was 90 people we talked to. It was some big number.
Something like that.
Yeah,
They called me to say, well, why haven't you done any more? And I said, because your leads are awful.
We can just throw our money over the side of the cliff or give it to you. That's your call.
Why is that? He said. I said, so I went to explain it to him. I said, they might be bad. They might be okay for your run-of-the-mill stockbroker. I said, but the other thing is you send them to stockbrokers too. You send them to people who aren't 100% fiduciaries.
Which
he goes,
they
no, they're all
claim
fiduciaries.
Yeah, they claim that was.
Oh no, I know.
We competed on those pros, and we knew who they were calling.
Well, and here's what I did. I went and signed up.
So now you're a lead.
So, well, yeah, but I used a fake phone number. But I signed up, and the people, they sent me the names of the advisors that they recommended, and every single one of them was a broker-dealer. Every single one of them. Very frustrating.
Their ads are all over the place. They advertise almost as much as Ken Fisher does.
Oh, so my gosh, they do. Yeah. Anyway, so I just told them the truth. I spent probably 45 minutes on the phone with them, and they keep calling to try to convince me that they're doing better.
No.
But they're not.
The answer is
because I keep going back and trying them again, going, no, you're not doing better. No. So anyway, yeah, the odds are if you go through that, the advisors you're going to get are the I'm a fiduciary part of the time, but some of the time I'm not, and that's
most of the time I'm not.
Yeah, that's the time when you're going to get a bad investment. But all really bad joking aside, Frank Vasquez, who does risk parity radio, where he discusses the different portfolios, like the all season and the golden butterfly portfolio, among others.
Yeah. Mm.
Is it really useful when we near retirement, those kind of portfolios?
I don't know, Frank, but I think I can unequivocally say no.
Well, what he does, one of his portfolios, these are really complicated. One of his portfolios is an expensive ETF that he suggests, in which they have 90% of the portfolio in bonds.
90%.
That's the safe part.
Yeah.
And 10% in S&P 500 call options.
Oh, call options. Okay.
So they're playing options against bonds as a risk reduction technique. And the reality is that playing options can be a very dangerous game. It's also expensive. And really, when it came right down to it, their returns were no better than a relatively conservative target date fund, for example, with lower fees. So I don't think a lot of it. I think it's gimmicky. I just don't like gimmicks.
And we'll go back to it. So this is a newsletter of some kind?
Or
they actually manage money?
It's a podcast that I don't think they actually manage money.
Okay. I mean, because we know the newsletter industry is rife with really bad advice. We know newsletter industry is rife with ideas that sometimes work for a period of time and then most of the time don't over the long haul. And the newsletter industry has no legal responsibility to you in any way. They can say whatever they like, and then they stand behind the First Amendment. Oh, this works great. And then when it doesn't, that doesn't matter because we are protected by the First Amendment. So it's not an industry that I would use for my investing advice. Period.
Yeah, and that was my daughter calling on another line.
Is she with SmartAsset now?
Yeah, no. I think she's calling about something entirely different.
At lunch maybe or something?
No, she's having some issues with her health insurance at her company. And so, of course, what do? You call Dad.
Oh, you're a nice guy.
You call Dad. Yeah, he's like, Frank is a retired lawyer, and he invested in his own accounts, and now he suggests things, and he asks you to support him by sending him Ethereum.
Okay, so just to be clear on this program, we've talked about target date funds, target date, right?
Right.
We talked about SmartAsset.
Mm-hmm.
We talked about Roth IRAs versus Roth 401ks.
Mm-hmm.
We talked about Frank Vasquez.
Mm-hmm.
I think that's just about enough for today.
Okay, let's call it a podcast.
Honestly, I think that we've done our job. Not
Are
well, but we've done it. I think so. Yes.
Well, we did it. That's
right.
what counts.
All right.
You don't always have to do it well. You just have to keep plugging. And that's our motto. Eventually, we'll get it right. Thanks for listening. I'm Don McDonald. That's Tom Cock. And we're going to hang out talking real money and answering questions. That kind of stuff.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future, so past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. Are we done now?